YouTube, welcome back to the Investing on a 9 to 5 YouTube channel. It's your boy, the Dividend Dog. On today's video, we'll be going over GARP, what is growth at a reasonable price? And also, we'll be going over the ETF that I'll be attacking right after I accumulate 100 shares of SCHD. But before we dive into the video, want to give all you guys a shout out there for hitting the like and subscribe button on the channel. It's helping the page grow, and it's letting us know you guys are liking our content. And if you're new to the channel, don't forget to hit the like and subscribe button so you do not miss out on any future content. So, guys, what is GARP? First, GARP was popularized by legendary investor Peter Lynch. GARP, growth at a reasonable price, is an equity strategy, investment strategy that seeks to combine both growth investing and value investing to select stocks. So, GARP investors look for companies that are showing great consistent earnings over time. So the overarching goal is to avoid the extremes of either high growth or value investing. So this typically leads GARP investors to growth oriented stocks with relatively low PEs and normal market conditions. So next up is the PEG ratio, or the PEG. The PEG shows the ratio between a company's PE ratio, valuation, and its expected earnings growth rate over the next several years. A GARP investor would seek out stocks that have a PEG, or PEG, of 1 or less, which shows that the PE ratios are in line with the expected earnings growth. So this helps guys uncover stocks that are trading at reasonable prices when the market is, decide to take a pullback, and the prices are all down 10, 15, 5%, or sometimes 30% down. You can take a look at the PEG ratio just to take a look to see if the company is still in line with this expected earnings growth. And on a bear market or other downturn, stocks, one could expect the returns of a GARP investor to be higher than those of pure growth investor. That brings up to my next ETF, the Invesco S&P 500 GARP ETF, SPGP. Right now, it's tickered at priced at 88.31. As you guys can see, the 1-year chart, it's been pretty flat here, so I'm liking my chances of getting in here, going long term with it. Looking at it from a sectors wise, it's kind of funky in here. We got a little energy, minerals. We got process industries, electronic technology, health technology, technology services, finance, transportation, consumer durables. So a lot of boring stuff if you're really, if you're really looking at it from the outside in. But let's take a look at it under the engine here. So we got it at 100% being here in the United States. PE ratio for this ETF is at 12.5, and it's got $177 billion market cap. And it's a 1.1 dividend yield. So we're really not looking at this to, really get a dividend out of it. I'm looking for to be more of a growth stock. So Morningstar is giving it a 5 stars out of the last 10 years as a 5-star. Right now on Fidelity, they're giving it a B. Now, the top holdings is really what I like about it. It's very, very diverse. We got Meta, NRG, DR Horton, Lamb Research, Google, KLA Corp, West Pharmaceutical Services, Applied Materials. You got Hologic and Corvo. So these are all just diverse companies that are all trading at very, very, or more likely low PE ratios compared to their sector and their competitors. And they also have huge earning expectations down the line. So as you guys know, instead of just going out buying these companies individually, let's just all get them all together in an ETF and let the ETF do its work here. And if this ETF has been performing. So over the last 10 years, it has returned 14.12% over its lifetime inception, 14.3. This past year, it's down 0.5%. Not worried. Up past 3 years, up 16%. 5-year, 12%. As you guys can see, compared to the S&P 500 here. 52.7% of institutionals own this ETF. So this is good to see. Just again, not another indicator or financial advice to tell you guys to go out and load up on this stock. Just showing you guys some facts here to help, make you think on it. Hypothetically, if you were to put $10,000 into this stock back in December of 2012, it'll be around $42,000 as of today. Now, this is the interesting thing that I saw here. So this is total returns for SPGP versus DGRO, SCHD, VU, and VYM. SPGP is up 423% total. That's including dividends and everything reinvested back into the companies. As you can see, VU is coming in at a second place at 407%. You have SCHD, the mighty SCHD, at 312%. You got the VYM at 250%, and you have DGRO at 155% total returns. Now, I do like DGRO as well, but I think I'm going to not think I'm going to pair this up with SCHD to dynamic duo it up to go down the line long term with it. So the reason I like bringing up DGRO because it's popular in the dividend community. Now, the reason I like this over DGRO is because you still get the exposure into Pfizer, Chevron, Apple, ExxonMobil, and Broadcom. So you, even though you're not getting into DGRO, getting these uh, top performing companies such as the ones here listed, SPGP, you're getting these valued stocks that are priced at a reasonable price, that are actually priced cheap, that you do not see going across your screen every day besides Meta. Now, comparing SPGP, DGRO, SCHD, and VYM. Now, you are paying a little more from an expense ratio, but you are getting a lot of value than with what you're paying. Only reason I'm saying this is because from a concentration risk standpoint, SPGP has the lowest concentration risk. And that means that the companies that they have are fully invested in are at a certain percentage where it's not that huge of a risk to basically go to zero or dilute the ETF essentially. So the lower that number is, the better. Also, the tracking error, how close as it is and how efficient is it to tracking the exact sector as to what it's saying, that it's tracking. Now, a lot of these ETFs, they do say they're tracking what they're tracking, but how closely is the management team making sure and ensuring that they are tracking these very closely? Now, granted, SPGP does have lesser companies than all three of these ETFs, but they are doing a great job on making sure that they are holding the best of what they're holding. And guys, that is all that the dog had for you guys here on Investing on a 9 to 5 YouTube channel. Thank you guys again for joining me on this video on SPGP and looking at the dynamics behind it. I'm definitely going to go long on this one, guys, to get some shares in it. Picked up one share today. Looking to pick up a few more here in the next couple of weeks or so on. But let me know in the comments, guys, on the ETF, and if you're looking to add it to your watch list or add it to your portfolio. Thank you guys again. Don't forget to hit the like and subscribe button on the channel. I'll catch you guys again on the next video. I'm out.